Brilliant. So I will start with a quick introduction about myself. So Ishita Pandey, I work in investment banking in Barclays, and over the last sort of couple of years, I've been involved with valuation of pretty sort of, from small to big companies, from anywhere to, but we've done it for ASOS, we've done it for Hive, we've done it for Gatwick Airport. So I would sort of just like to add that I've been involved in this day in, day out, and I wanted to give you a little bit of a perspective on how the investors and how the bankers look at companies, and hopefully sort of, over the session we can explore some of these concepts, and you can ask me any questions that you might have. Quickly setting out the roadmap for today, the very first sort of section will be just setting out some of the concepts, and we will talk a little bit about how valuation works, how cap tables work, what they're used for, how you can really sort of start thinking about them. This is maybe a lot of you might already know some of this, but I think it's still useful setting it out for those who might not. The next section, we will do a deep dive into sort of very specific valuation methodologies and see how we can actually use them and take some numbers, some rough numbers, and how you can apply them to come at a valuation for your company. And this includes a bunch of methodologies like benchmarking, how you can look at VC returns, how you can sort of, look at your cash flows, and so on. The next section is sort of a detailed introduction to cap tables, and I've got a model that I've set out that I'm happy to share with you guys after the session. And it just shows how you can sort of not just list your investors and the percent of your company that they own, but how you can build functionality to sort of model in liquidation preferences, model anti-dilution preferences, how that would impact you as a founder, and so on. Well, I wanted to start with a quick video which sort of sets out why the topic that we're covering today is very important. So I'll just play that now and we can pick up after that.
Boosted Board, the California startup that popularized electric skateboarding and helped to bring electric skateboarding to the mainstream, is failing. How did this hugely popular electric skateboard company that raised over $70 million fall this far? With more money comes intense pressure to continue growing no matter the cost. As venture capital investors look for a home run on their investment, they push for supernatural and hyperfast growth instead of organic and natural growth. The only real option for a company that has taken significant venture capital money at this point is to eventually, option 1, go public, such as on the stock market, or option 2, to sell. Then there's always option 3, the least desirable but the most common, to go broke. Boosted raised about $75 million from investors. Most recently was a $60 million round at the end of 2018. Yet here we are, just a little over a year later, with the company unable to pay their debts, having to lay off much of their staff, and looking for a buyer. So what happened? $75 million. What I think plays a big part of the fall of Boosted was the huge amount of venture capital money that they raised. How can raising $75 million be a bad thing? Let me explain. Once you take that venture capital money, don't think that there aren't strings attached, because there are, and there are a lot of them. Investors expect a return on their investments, and the more money that is invested, the higher the expectation of a home run. So instead of being a little mom and pop shop focusing on natural growth through a solid business model, there were huge expectations for almost impossible growth at no matter the cost. This intense pressure often leads to poor decisions and waste. It pushes companies to grow too fast and to move into markets or areas that they're unprepared for, all in the search of growth, and all with an expectation to go public on the stock market or to sell to a bigger company. In Boosted Board's case, because they were so beholden to their investors, instead of focusing on their product, the electric skateboard, they ventured into scooters in search of growth. It reminded me of a quote from the show Silicon Valley. Jack Barker, one of the characters in the show, says this.
Richard, listen. No, you listen to me, Jack. You promised me that you would never compromise the product. So, do you feel like taking some action and backing me up on this? Because me and my product feel pretty compromised right now.
Richard, I don't think you understand what the product is. The product isn't the platform, and the product isn't your algorithm either, and it's not even the software. Do you know what Pied Piper's product is, Richard?
Is it me?
Oh, God, no. No. How could it possibly be you? You got fired. Pied Piper's product is its stock.
Well, with that very gruesome video fresh in our minds, let's just talk a little bit about what just happened there. I guess the main reason why I wanted to play this video was because investors and founders think about businesses in very different ways. So while for a founder it might be, and it should actually be, all about the product and all about what you're doing, for investors, it's often about raising money and actually investing that money wisely. Now, working the way that I do in banking and sort of personally investing as well, I can tell you that while I would look at products as well, the most important thing is the returns that that product would make. And does that, it could be an excellent product, but if it doesn't translate into concrete returns, and if there isn't a sort of solid business model backing that product, it just doesn't work for investors. Another sort of very important point is, in a lot of these meetings that we attend and the investment committees that we do, it's not always about upside. There's also downside protection, which forms a very important part of all these discussions. So a question that we often get asked is, well, how would this company perform in a recession scenario? Now, maybe, and bar the coronavirus crisis, it's very, very, very unlikely for recessions to happen in Western economies. And yet we always sort of build very detailed recessionary cases in our models. So this is sort of the reason why this topic is extremely important, is because as a founder, you need to be very aware that how you might be thinking about the company, i.e. in terms of product, might not be completely aligned with how investors and sort of bankers think about it, which is more in terms of how that product translates into returns and essentially what the price or the stock of the company translates to.
Boosted Board, the California startup that popularized.
Brilliant. Now that we've got the fun video out of the way, we can dig into some of the analysis. So the very first topic that I wanted to cover was that why do you think you really need a valuation? Now, if you're a mature company, you would pretty much just always think about it maybe in terms of signaling to investors that, well, you know, look, I'm available. I've got a pretty good sort of valuation range. This is what my metrics look like, and this is how you can invest in me. Now, that is only one part of the story. I would say there's a very, very important reason, but there are other much more or equally important reasons why you should start thinking about it in these terms. Another very important point is measuring KPIs. So if you're looking at your valuation in the correct way, you will be tying your valuation to the metrics that actually drive it. So for instance, if you're a company that has subscription-based revenues, you should probably be thinking about your valuation in terms of what each pound of that subscription revenue means in terms of value. So if each pound, for instance, if you think about lifetime value, if each pound translates to 15 pounds in the lifetime of your company, well, then your valuation is 15 times that particular metric. So if done correctly, you can actually measure KPIs very effectively and tie it to your valuation. The next important point is signaling to employees. So when you're an early stage startup, or whatever stage you're at as a company, especially so for early stage startups, you want to tell your employees that there's upside built into the business. You don't, well, I mean, as much as I propagate working and, you know, toward your passion and doing what you really want to do, people do want money for what they're doing and good upside. Pretty much every industry or every sort of, you know, high growth or highly motivated individual that I'm aware of really thinks about life in these terms. And you would, and if anyone was to, let's say, you know, leave their comfortable job, an expert, and take up a job as a startup, they would be willing to take a lower salary, but only if there was a credible upside. So you would want to be signaling that, well, you know what, while we might not be paying you so much right now, actually our valuation implies that if you own X% of the stock, you could be a millionaire in 5 years. Going on from there, the next couple of slides talk a little bit about how you can think about valuing early stage versus later stage businesses. the earlier stage that you are, the less formal metrics that you will have. Essentially, that means that your valuation would be quite informal. We can see that in a lot of startups in their very, very early stages would not be doing priced rounds. So they would essentially issue some kind of convertible bonds or equity, convertible debt, which converts into equity at a later stage when they have enough metrics to actually warrant a priced round. At this stage, a lot of things matter. Qualitative factors are very, very important. So for instance, do you actually have a product? Do you have a roadmap? Do you have a great management team? What does your market look like? And so on. Later stage businesses have a very specific way of valuing. You would almost always have very, very concrete cash flow metrics that you could tweak up and down. So for instance, how does revenue translate to cash flow? So what are your costs? What are your fixed costs? What are your variable costs? When you grow, how does your cost base grow? And what does that mean in terms of money that comes in the door? Now, money that comes in the door belongs not to the company, but the free cash flow belongs to the investors. And that is why that is a very important metric for later stage startups. Another very important way is using benchmarking, something that we call benchmarking. And what that means is you look at other companies around you and you try and understand, and you make this implicit assumption that, well, if I'm trading in the same industry, well, then at some point in the future, my multiple will be equal to the market multiple. And that you can take that industry, so-called industry multiple, and apply it to your earnings to get at a sort of sensible valuation range. In this slide, I've just set out some of the ways that you can think about valuation. So for instance, let's say you're very early stage and you only have users and you don't have paid users, you just have unpaid users. Well, then the next sort of reasonable thing for you to do to translate that user number into a valuation is to try and get at some kind of lifetime value of user. So perhaps you start thinking about, well, let's say you have 100 users. What is your conversion rate? Maybe you convert 10 users. How much are you going to charge them? Maybe you charge them £10. That gives you £100. That's just a completely illustrative example, but that's sort of how you would go about thinking about these things. Now, some of the metrics for later stage companies are very related to revenue, very related to earnings, very related to cash flows. But you could take that principle and apply it to essentially anything. The only thing that you do need to do is you need to be able to build a credible bridge from the metric to the value. How does that metric translate into money, essentially? Now, that being said, there are very important qualitative factors as well, because you can have the best metrics in the world, but you could, if you don't have a good management team, if you don't have a great idea, if you've not really taken time to think about the market and how, for instance, if there's, just a completely random example, let's say you have an amazing idea to build an absolutely phenomenal product, but the industry that it falls in is defense. Now, defense is a very particular industry, and that just means that you could be in a position where perhaps your product infringes on some government regulation. So these are sort of qualitative factors that people can and do miss, but they're very, very important and should be kept in mind. And I'll talk about this a few times, but valuation is it's not a number. It's not a number in isolation. It's not a number that, well, often people do it, but it's not a number that you should just pick out of thin air. But ideally, it should be a range. So in banking, when we think about valuation, we usually have a chart, which we call a football field, and you have anywhere from 10 to 15 metrics, each of which shows a range in price and in multiples. So, and the hope is, very much the hope is that all your valuation guides you to a sort of narrow, well-defined range. And you can say something like, well, look, we looked at it from the customer point of view, we looked at it from the market's point of view, we looked at it from the cash flows point of view, and we looked at it from the returns point of view. But pretty much everything gives us this 1 to 1.2 billion value. And that sort of is a very Of course, if that number is 1 to 5 billion, that becomes very unjustifiable. But if that number, if you're doing it correctly, you would usually be able to find 5 or 6 metrics that define how you can set that range. The way to correctly do this is to sort of really think about this during the method as well. So you can sort of, for instance, introduce checks. So I do that a lot when I'm modeling. I would put in a lot of checks that if, for instance, if some number goes above, example. So for instance, if I'm looking at a company in the industrial space and the multiple, the very first thing I would do is I would look at the market and see what the multiple is that the normal peers trade at. Now, if that multiple that I sort of deduce for the company turns out to be 5 times as high, I would absolutely know that I'm doing something completely wrong, because that should not be the case. In terms of thinking about how it affects you, you should also be looking at how much equity are you willing to give up, like how much money are you willing to raise. So are you raising $1 million and giving up 30% of your company? Doesn't make much sense. Or maybe you're raising 50 million and giving up only 1% of your company. So these are sort of checks and questions that you should be thinking about all the time. Next one is you should be thinking about what are you going to use the funds for? Are you going to use them for a purpose that will sort of be accretive to your company in the future? Are you using it, basically the valuation that you're setting now and the funds that you're raising now, will they translate into a higher value in the future, in which case your company grows and you get an up round? Or is it maybe, you could cut out some of them? That sort of wraps up our quick valuation section. Moving on to cap tables. Well, I'm sure a lot of you already know what cap tables are, but just setting them out very, very quickly. It's essentially a list of people who own money in your startup and what % of money they own. That is essentially the long and short of it. Now, when you're looking at it in a very simplistic way, maybe that is enough. But if you've got more than 2 or 3 investors in your business, maybe you can start thinking about what terms you're offering them. So each time an investor comes in, they will not just be thinking about, okay, well, I've got this % of this company. So when they exit at 100 million, maybe if I own 10%, I'll get 10 million. They will also be thinking, well, what happens if they don't exit at 100 million and they actually exit at 50 million? What happens to my money then? Am I happy with the 5 million? Or maybe I want some kind of protection which says I should get at least 10 million before anyone else gets paid. So you can start thinking about, and I will show you how you can build this into your model and look at what investor returns will look like in different situations. Now, thinking about how you can use cap tables, there's a bunch of ways. You can navigate dynamics, you can negotiate with investors, you can look at different ways of funding, like, not just equity, but convertibles. You can look at how you can put in place option plans, you can track returns. It's essentially a way of looking at your company and seeing the financial future of your company. One thing I would like to point is that you should always try and get this in place before you raise any external funding. Hopefully by the time you, and if you have a co-founder, start talking about how and when you want to split equity and how, you should essentially have a cap table in place. So that covers off our introduction. Diving straight into the valuation section, we can start off with benchmarking. And like I discussed, you would look at what companies that are similar to you, what was the price that was paid for them. Now, when I say price here, I want you to think about it this way. For instance, if you're the same company, but at different scale, the price that would be paid for you would be very different. But the price that would be paid for every single pound of you would be the same. So another simple way of putting it is, whether you have 100 million revenue or $1 billion revenue, the total consideration paid for you would be different, but the consideration paid per pound for you would be the same. Now, with that in mind, the way that we think about this is, you would say something like, for technology companies, maybe 4.5 to 5 times revenue is a very good metric to sort of keep in the back of your head, that, if you've got maybe 100 million of revenue, you could be valued at somewhere around 500 million. I got some articles I was reading some articles on the FT, And I came across this very interesting article about this Indian startup called Oyo, which operates in the hotel leasing space. And the founder essentially said that they came up with this 10 billion number just by looking at, the earnings multiple that Netflix, Uber, and Peloton, the average of the three, was at, which was close to 4.5 to 5 times. So these guys had revenues between 2.7, 2.9 billion, roughly 4.5 times of that is 10 billion. So it sort of checks out. Now, I'm sure that they also looked at their cash flows and they used that metric, but I wanted to point out that it's actually very important and people do think about it this way. Now, when we're talking about benchmarking, another thing to remember is, well, how good is the data that you're using? Now, especially if you're a startup, it would be very hard for you to find very comparable transactions or very comparable companies to look at. It's really a trade-off, and it's really a comparison between what kind of data, how much data you have and how you can effectively use it. Now, looking at Oyo, I would not say that they're a tech company at all, because they essentially do something, they lease hotels. So they don't have a very technology specific product. They masquerade as a tech company. So the question that I would ask is, well, maybe they're overvalued, because why should they be trading at something like 4.5 to 5 times when they're not doing what Uber or Netflix or Peloton are doing? Interesting, but I thought I should put this little bit about WeWork here as well. And SoftBank, and this sort of signifies to you how important valuation is. But the last private funding round that WeWork did valued them at 47 billion. Now, if you've been keeping on top of the news, you would see that the public market valuation that they were going to IPO at was 6 billion. Now, that is dramatically lower than the 47 billion that SoftBank paid for them. And the IPO just was a flop. It didn't happen just because there was no way for it to happen. So I would say that as a startup, being undervalued is probably much better for you than being overvalued, because you want to get in the race, but you don't want to sort of show all your cards at the very first. And like with Boosted, you don't want this huge expectation of future growth on you, because if you've taken money, what that means is, if SoftBank has bought in at 47 billion, then that WeWork needs to be priced higher than that for SoftBank to make a profit, much higher than that for SoftBank to make a profit. If they're not, well, then all the very interesting provisions that SoftBank would have, and we'll talk about that, would have put into place, like liquidation preferences, would all kick in, and the founders would be left without money, essentially. Another interesting way of looking at returns is almost upside down. And this is, again, very, very common in banking, investing, and finance, that the investor would essentially look at what return they want, and they will almost back solve to get to the price. So I will think about it this way. Let's say I can afford to pay. It's called an ability to pay analysis. And how you would say is, well, what is the value of the company 5 years down the line? So let's say an industry multiple of 20 times for a normal industry, and let's say we expect the earnings to be 5 million, just as an easy example. That would mean that 5 years later, that translates to 100 million. Now, I would think if I own 10% of that company, that means I get 10 million down the line. If I want 10 times returns, I only want to pay 1 million. So that is how you would sort of take a number in the future and try and assess what you can pay now. It might seem quite unfair, and I agree, because you would say, well, why would you do it that way? Because it might be that my startup is more valuable, and the returns that you're expecting have actually nothing to do with the reality. But to that, the startup would say, well, tough luck. The venture capitalists would just say, tough luck. Well, that is just how we look at it. So you should sort of really think about, when you're valuing, do you think that the value that you're implying from the price and from the benchmarking, can the investor enter at that value and exit comfortably 5 years later with 5 to 10 times money? Another one is, again, coming back to growth. What growth are you offering for the valuation? Because if your valuation is very high right now and you only have so much leeway, so let's say you're already valued, theoretically, there's 100% valuation that you can get to a max at, and you're already at 80% of that number. how much more can you realistically grow? So an investor buys in at a very high value, and there's no way that they'll be able to make their return, because if you're already at 80%, they're not going to double their money, triple their money. It's not going to happen. So you want to price your value very corresponding to the growth that you can offer to the company. Quick snapshot from the model that I had. It just shows you that a VC, if they decided to enter at 5 million for a startup, how would you sort of exit? What do you need? Do you need 20 million? Yes, you need 20 millions to exit at 4 times. And we will cover in detail how we get to the 20 million when we get to the cap table section. Another important metric that does not get highlighted enough is the internal rate of return. It's a very easy Excel function, which essentially shows you what annualized return the company is making. Now here you would see that the number is about 60%, which is a good number. And the benchmark usually for that number is what the limited partners or the VC, who is giving the VC money. So the VC gets money from pension funds usually. So what is their return requirement? Because the VC needs to meet those requirements before it can get any of their sort of returns and carry. So if you're giving 60% compared with the 10%, now this 10% is a very low number that I've put here, but that's essentially what pension funds look for. The VC would usually look for a much higher number, but you should start thinking about annualized returns as well, not just money multiples. Another method that you can look at is the modified Berkus method, and this is for fairly early stage startups. And this essentially covers, well, if you've not really got any metrics, how can you assign a value? Well, you can perhaps take 5 or 6 very key sort of risks that a company might have and try to assign sort of a random value to them that seems somewhat sensible. So for instance, I say, well, you know what, I've got a really great idea that eliminates some aspect of product risk. It's better than having no idea at all. So that makes me worth $500,000. Now, I say I've got a great management team with people with 10 years of software sales experience. That really, really dramatically reduces execution risk. That makes me worth another $500,000. So you see what I'm getting at here. You can take, and you don't just have to pick these five factors. You can pick as many factors as you want and say, well, because we're eliminating this level of risk, this is what we should be compensated. Usually, I would suggest only doing this if you don't have another way of valuing, but you can use it in conjunction with other valuation metrics as well. And the last method, which is actually always the most scientific method, but doesn't get used enough in startups because you would not be able to forecast cash flows so well, is the discounted cash flow method. Without dwelling too much on it, it's a very, you sort of, again, try to assess what the free cash flow to the firm is. And that just means that after you've paid everything that you sort of legally need to pay, what is the money left over to pay the investors? You look at that to perpetuity forever. So you can, once you, let's say, forecast 10 years of cash flows, you can just apply, you know, a simple geometric progression formula to look at what that cash flow number would be forever. And that just sort of gives you what the value of the company is. So just entirely the value of its cash flows. Now that only works if you can reliably predict cash flows to that level, which if you're later stage, you probably can. If you're not, probably not the best metric to use. So that wraps up the valuation session. I think we're running a little short of time, but I thought we should open the floor now for questions, if that works. Scott, do you think that's okay?
Yeah, sure. There's no questions that have come through yet. If there's any questions that people want to ask, feel free to raise your hand or ask in the chat. I guess I've got a question actually to start off. So how, based on, I think all of these models are really interesting. When we're in quite a structured time, how do you price in like fluctuations around what's happening now with like COVID?
Okay, well, that's a very interesting question. And I have been actually doing that a lot these past few days. So we did, as I was mentioning to you before, we recently did the 250 million equity raise for ASOS, the 125 equity million raise for Hive. And a big part of my job was actually taking this massive, 2 gigabytes model and really trying to figure out how that risk gets priced in. And what you do is, there is no scientific way, but you haircut numbers. And what that means is, well, for someone like, for instance, if you If you're a subscriptions business, you just say, well, you try and take the maximum hit that you can. So you would say, well, what if your revenues are down 30%? Or if you're a business that's very reliant, like a hotel, well, we've looked at some of those, at least for myself, and you just say that you have no revenues at all. So you have zero revenues, and you just completely get rid of the revenues. And then you say, well, how much of the costs do you still need to pay? Because as a business, you would have fixed costs. So I suppose the way that I'm saying that you would do it is you would just haircut numbers, and it's very, very hard to get at a very sensible number. But I would say the more prudent, the better. That's how investors think about it.
Got it. Brilliant. Cool. I think you're moving on to cap tables now.
Yep, absolutely. Right. So I think we still need a little bit of time to cover this, but I'll try to be quick. So basically, like we discussed, cap tables are it's a list of your investors. It shows who owns what in your business. It's sort of a way of effectively saying, what is your company? You know, who is owning it? What does it mean in terms of returns? If we were to exit X years later, who would get how much, and who would get the money first, who would get it second? It's a waterfall. That's how I would say it. Now, when you start thinking about it first in the life cycle of a company, you would probably and I would almost always think about it in terms of valuation first and cap table second. So a good cap table should have what your current valuation is, and then what your valuation over time is, and at each of these valuation, who owns how many shares and what percent of that new valuation does it represent. Now, when you start off a business, you have no metrics. Doesn't matter what the multiple is, you're worth nothing at that point, but you do have 2 founders, and they each own, let's say, 1 million shares. You're prudent, you're wise, you decide to set aside some money, some shares for option pools. So let's say you've set aside 500,000 for option pools. So that is all your cap table is at that stage. Now, let's say, you go down 1 or 2 years down the line, you realize that actually, well, you know what, now we've got metrics, now we've got numbers, and now we can actually, have a decent valuation and raise money. So let's say in your seed round, you have £500,000 of revenue, or whatever metric that you're looking at, earnings, users, or lifetime value of users. And let's say the industry that you're operating in has a multiple of 12.5 times. So for each pound, you get 12.5 pounds. For 500,000, you get 6.25 million. Now that is before the investor enters. So you already have that. So that is your pre-money valuation. Now the investor gives you some more money on top of that. And just because you sort of want parity with your valuation and the cash in your business, you add that number to the top of it, because you assume that you will use that 50,000 and use it in your business to make your business better. So technically it adds to your business. So now you've got a higher valuation. You decide the price, which is essentially your pre-money valuation divided by your pre-money number of shares, and you get at how many shares you have. And essentially that just means that you pay 20,000, you give 20,000 shares for the money to your angel investor. Can go through it again. Let's say you raise your second round, you do the exact same thing. So that is how you would think about getting angel investors in. Now that is the easy part. When you get venture capitalists in, that is actually a lot more complicated, because they would not be very happy with just, regular terms and options. They would actually want a lot more. So you do the exact same thing that you do for your angel. You sort of, figure out what your valuation is, you figure out what the price is, you figure out what the shares are, but you go a step further and you start thinking about what would the returns be for the investor. Now we'll talk about how we get to this 20 million number in a little while, really quickly in the next few slides, but you say, okay, well, this guy came in at 5 million. Let's say if we exit at 135, this is not the 9%, and I'll explain to you why this isn't the 9%. But let's say their exit value is 20 million. Well, they get 4 times their money. They're the last investor. Maybe they were in just for 1 or 2 years. That is a pretty good return. So things are starting to make sense. Similarly, the Series A, who entered before the last investor, gets slightly more than them. Again, starts to make a lot of sense. Now to the really fun part about the different sort of terms that VC investors would have, and what that mean in terms of returns, and how they translate into your cap tables. we can go into a lot of detail on this. This is very technical. I've got the model all set up, which I will share with you, but let me sort of get through it, and then you can ask me your questions and maybe we can dig into it that way. So there's something called liquidation preferences. And what that means is that you have to guarantee to your investor that before anyone else gets paid, they get paid, let's say 5 times their money or 3 times their money. Now you would say that seems quite unfair because, you know, well, we're the founders, we're doing a lot of the work, but they would sort of counter that with saying, well, we're giving you external money, we're not really vested in the business, and we're not really taking the full upside. So we're saying we're only getting a 9%, but we do want downside protection because it's not our business, we're investing in it. So we want some upside in case everything happens and everything goes wrong, essentially. So you're essentially, when you agree to that, you're telling them that, well, you know what, you're going to get 3 times your money before anyone else gets paid. What that means in practice is, if you have a down round or if your exit is not as good as you think it is, it could mean that you get nothing at all. So if you, in a really, really sort of bad case scenario, so I found this interesting article on TechCrunch, and it said that, you know, most employees would think that if they own 1% of a 100 million company, maybe they own 1 million, but that's actually completely wrong, because it could mean that if that business is valued at a down round, they could actually get nothing at all, because, and this is at 1-time liquidation preference. Usually liquidation preferences are 3, 4, 5 times. So in that case, not just the employees, no one gets anything except the VC. So it's a method of downside protection, and you should be careful when you're negotiating it. Now, what that means is you're negotiating a whole term sheet. So you're negotiating your valuation, you're negotiating all the terms. You should really be thinking, what does it mean? So if I give a later stage investor a 5-time liquidation preference, what does it mean in bad situations? Does it mean that that investor will push to exit because they will make their money anyway? And that is what happened in the tech bubble. So when the tech bubble burst, there were a lot of later stage VCs that had very strong liquidation preferences, and they said, screw you to all the other investors, and just exited, got their money, and everyone else was left with nothing. Now that is very bad practice and very sort of bad in terms of bad way of doing business, but it does happen. So you should sort of be very careful, and you should always try to not overcompensate on terms. So if you have to pick one, sort of don't compensate on terms, compensate on your valuation, I would say. Again, this sort of talks a little bit about why you should sort of think about all of this holistic valuation terms and everything in one bubble, rather than say, okay, let me evaluate, let me sort of really sort of negotiate very hard on valuation, because then you might not have enough room to negotiate terms. So they'll say, well, we already gave you what you wanted on the valuation. The least you can do is give us the terms. So I would say you should aim for a fair price, and you should aim for fair terms, and you should try to find a balanced middle ground for all these factors. Now, the way that you would model these preferences usually, again, I've set this out in the model, and I've set this out how it would translate into your term sheet, but there's a few ways that it works. So the very first is that you have a minimum preference. So that would say, okay, if the business, whatever the business exits at, I want my 3 times. So if you came in at 5 million, your 3 times is 15 million. So you make the 15 million minimum, or whatever the business exits at. So let's say if the business exited at 10 million, you would take all of that and no one would get anything else. The next thing that you have is a cap. So now VCs say, well, what if it's a home run? I don't want to say that I just want my 3 times. I actually want a little bit more than that if the business has an absolute home run. So they say, well, we will participate in the common profits after we've got our liquidation. So that means you can say, well, they can participate completely, but why would the founder want that? If you've already got your 15 million, you've already made your return, why would you participate? Why would you get 9% of everything else that's left? That just doesn't make any fair sense. So you would say, well, you can get 9%, but you will only get it up to 20 million. That seems decent, that seems reasonable. So if we do really, really well, you will get more, but you will only get more up to a certain limit. So you say, okay, so that's the second term. Now the third is, what if it's an absolute blockbuster? Well, then they just convert to common equity and take the 9%. So, you know, if you exit at completely just knock it out of the park 100%, and the 9% actually is more than 20 million, they would just convert to common equity and take that money. So I suppose what this means is that they get the best of every world. So the way that term sheet negotiations work, investors usually try to get the best of every world. So they will have downside protection, they will have upside returns, and they will also have the chance to have a complete home run. So thinking about all of that is super important, because you should really think about these terms and try to negotiate them, because 3 times or 4 times or 5 times, depending on how big the number is. So if the number is 100 million or 200 million, a difference between 3 and 4 times can be absolutely massive. So you should be thinking about all of these things when you're negotiating. The next sort of very important kind of provision is an anti-dilution provision. This is even more technical, I would say, than liquidation preferences. And I've sort of, again, modeled it out for you in the spreadsheet, and we can talk about it a little bit. What this means is that usually when you have a funding round, everyone gets diluted. So that is just common sense. It just says, well, if I issue more shares, so let's say my business had 10 shares and I owned 1, so I owned 10% of the business. If I decide to issue 10 more shares, that the business, I will still own the 1 share, but the whole business will actually have 20 shares. So I won't have 10% now, I'll only have 5%. So that is essentially what it is. So you will always have dilution when you issue more shares, but this is sort of dilution in ownership. What investors absolutely hate is dilution in economic terms. So if your price rises and you own the same number of shares, you actually don't mind. Well, you own a little less of a bigger company, so your total monetary value of your investment is actually still greater. But things really start to get ugly when you have dilution, so you issue more shares, but you issue them at a lower price, because then that means that the investor actually owns a smaller part of a smaller company, and that's when your anti-dilution kicks in. And what that says is that, well, there's 2 kinds actually. So there's your full ratchet, which is extremely unfriendly. You should never agree to this, and almost no VC will ask you to agree to this. And why it doesn't make sense is because it says, even if 1 share is issued at a lower price, the investor's whole holding is worth more. And how that works is preferred equity usually. So VCs will invest through preference stock, and that preference stock has the option to convert into common stock at a price. Now, normally that price is 1 for 1. When you have a down round or you've got a bad situation, that price actually of conversion becomes the price of that round. So I'll give you an example. Let's say, I own 10 shares and I bought them at £1, and I have the right to convert them to common equity at £1. So that just means 10 shares at £1, £10. If there is a lower round, so let's say in the next round, the price went down, company did badly, price went to £0.5. That means my value is actually only £5 now. So I own 10 shares, but at £0.5, so £5. The full ratchet will give me the right to have that price. So my conversion price will not be £1 now, it will be £0.5, which means I will actually now have 20 shares, not 10 shares. 20 shares at £0.5 is actually £10. So I get the full money. Now, this would be okay if you were having substantial dilution, but if you're only really diluting for 1 share, so if you raise a very little amount of money at a low valuation, the whole investment of that investor gets converted at a lower price. What that means is that the founder's ownership effectively gets wiped out, and everyone who doesn't have that protection gets wiped out, because you issue a large number of shares to some other investors. All the other investors get nothing more, which just means that everyone's percentage ownership falls. You've got a lower price. Effectively, everyone except the person who has the provision is screwed. There is a middle ground that almost everyone negotiates, and that is called a weighted average provision. It's a simple sort of mathematical formula, and it essentially adjusts this conversion price, so the conversion price of preferred equity, and it says, well, let's think about it sort of a bit rationally. Let's only adjust the price down for the amount of actual dilution in terms of shares. And this will sound a little bit cryptic, and I'm sorry if it's a little bit, too technical, but you say, well, if you had a theoretical equal round, so let's say you didn't have an up round, you didn't have a down round, the price stayed, £1, what would be the number of shares that would be issued to the new investor? So you take that number, you add that to your full shares, and you divide that with what the actual number of shares issued is. So usually this number will be something less than 100%. Now that just means that your conversion price goes down, but it doesn't go down all the way to the bottom to the price of this round. And that just means that you still get some protection, but you only get economic protection. You don't get any protection on top of what you actually deserve in terms of number of shares. Again, sort of modeling this out, it's a bunch of choose functions on Excel, a bunch of if functions, nesting ifs within each other. I'll share the Excel with you. It's not very pretty. It's just sort of, that is how you would think about this. In terms of context, I've come back to my favorite example about WeWork. And essentially, when the We company decided to do their IPO, it turned out that because the actual valuation was 6 billion compared with the about 47 billion that SoftBank bought in at, actually all the anti-dilution provisions that SoftBank had kicked in. What that meant was that SoftBank actually, who was making still very, very big losses on the investment, would still have some protection, and they would get 400 million worth of shares just to sort of lower their losses. Now, the 400 million that SoftBank gets means 400 million that other investors and founders don't get. So you should keep that in mind. It's essentially the anti-dilution reassigns value from the founders and the earlier stage investors to the later stage investor who actually has the provision. So that is the provision. The very last thing I thought I would talk about is convertible notes, and Stefan sort of touched on this a little bit. There are times when you might not be able to price your company, and then you think, well, but we still need money, but we don't really know. So we might sort of accidentally give away a bigger chunk of our company than we actually should be giving away. So in that stage, you can just say, well, why don't we take the debt, and why don't we give an option to the investor to convert that debt into equity, maybe when we have the next round. Now, because that investor is giving you money and loaning you money, you would usually pay them interest, and interest on these are very, very high. So they would be between 8 to 10%. Now, 8 to 10% might seem like a small number, but if you compare that with the benchmark interest rate of the Bank of England, which is, I think, at 0.25% now. So the Bank of England lends money at 0.25%. You're borrowing money at 8 to 10%. So you're paying a lot more than you would. Now, that just means that it is a good deal for the investor. On top of that, big interest that they get to sort of compensate them for the risk that they're taking, they also get to convert. And usually they get a discount on converting. So let's say you have 50,000 worth of, note amount. So someone sort of gave you £50,000 and said, take this. Here is my money. You don't have to price it right now. You can use it. You decide to pay 10% interest on it. That means you, at the end of the period, the accrued amount is 66,000. Let's say the pre-money valuation for the business, when you actually do decide to do one, is 9.375 million. What that means is that investor actually will be paying you less than what the price of this round would be. How much less? Depends on what you've negotiated. So based on this valuation, the price is actually 375. But if you've said, well, I'll give you a discount, the price for this investor will be lower. So you'll be diluted more, because when the price is lower, you issue more shares. So for the same amount of money, they get a lot more shares. Now there's an even worse provision which says, actually, you can cap that valuation. So instead of just a 30% discount, you actually could say, well, the valuation cap is 8 million, which just means that I will pay the price that 8 million implies. I will not pay the price that 9.375 million implies. Now I've got two scenarios, and essentially when the price is low, it's not that big a deal. But when the price is high, like it's at 15 million, actually the price implied is 590, so almost £6. And the price that the investor would pay would be 315. Now, this would only be possible in the form of a convertible note. This just essentially means that they buy at a much lower price than everyone else. And again, as with VC investors, they always have the choice. So they will say, I will get the interest and I will have a choice between whether I want to take a discount or whether I want the valuation cap. That just means that they will choose to do whichever gives them the most number of shares. In context, I think these are super popular. So convertible notes, extremely popular with startups, extremely popular with companies. And I found some articles which said that, and as I've observed as well, that it's really not worth kicking that can down the road. So you have to really sort of start thinking about what does it mean, because it's not debt. At the end of the day, it is debt that converts to equity. So you should be thinking about, well, what if it converts at this price or that price? What does it mean to my valuation? Like, how much more money do I have to how much more ownership do I have to give away? What happens when I exit? How much less money do I get? How much less money do other investors get? And sort of start thinking about it in those terms. Okay, so that was the end of the cap table section. I have got, I will be writing a blog post actually covering these key points, and it'll be available on my blog. And I think Scott said that he would send it to you guys as well, so you can pick that up. I've got a very detailed Excel model from where I had all the snapshots. So you can use that, I'll share that with you, and you can sort of go through it. You can ask me any questions on it. Also, more than happy to do one-on-one sessions. And just to clarify, my employer does not allow me to accept any payments. So this would have to be completely free from my side, but I would love to give up more of my time to help you out. Just drop me an email, let me know how you want to sort of proceed with this.
Fantastic. That was really, really informative. Thank you so much, Ishita. One of the big things I picked away from that myself actually is you say don't compensate on terms, but kind of be more progressive on the valuation side of it. And I think that's really interesting where you think about like accelerators. A lot of startups, they think, let's go into an accelerator. They're really progressive environments. We can grow a lot faster than we could independently. And we've seen like YC, Antler, Techstars, they all have pretty fixed terms. Yeah. And it's either take these terms or don't. Yeah. And I think we're seeing a bit of a shift now where YC have just gone away from 7% to downgraded to 4% of taking equity now. And I think it's where a lot of teams are coming more susceptible to that. Don't just take these terms, actually put some structure behind it. So that was really interesting.
But yeah, Y Combinator actually sort of, innovated safes, which is a kind of convertible note. Now, I would like to add that, this is not like, you have to sort of think about this. These are very hard investors. These people aren't there to sort of help you run your business. They're there to make a return for their LPs. And just the way that it works is, VCs don't own the money that they invest. They actually have limited partners who own the money that they invest. And what that means is, if they don't give the limited partners the return that they want, that tap will turn off and the VC will close. So they're not doing it out of, no one is doing it out of the goodness of their hearts. They will negotiate hard and they will sort of try and get great terms for themselves. So it's just, you have to be very, very careful and read every legal, like don't sign legal documents without consulting a lawyer, without actually going through them in detail and understanding what they mean.
Yeah, I think that's a great point. Actually, Stefan, who asked a question yesterday, we did office hours and we were actually debating this topic. And I guess my argument against that is, like, VC funds now, they need to also be quite aware of having that strong relationship and brand image. So if you are just tied to just getting the best valuation and deal for your LPs, of course that comes into it, but you also need to have a good relationship with your founders and how you basically have that communication there. Because if you try and get a deal on your next fund, then it's going to be a lot harder if you have a bad reputation in the market. So I think they have a more challenging time than just, hey, no, whatever it is, we just want to get a return.
No, 100%, 100%. So they have a very hard life as well, because they have to balance the need of their investor with the need of the actual companies that they represent and fund. And yeah, I mean, and VCs that get a bad name ultimately do go out of business. Like the best VCs, Sequoia, sort of, Dawn Capital in London, all of them have amazing progressive sort of relationships with the founders. And that is a big part of the VC business, like building these lasting good relationships. And I was reading an interesting article on Sifted, which was talking about how, well, this is because everyone can stand behind their money when times are good. But what really matters is who stands behind you when times are bad. So if you're screwing over the founders right now, it's probably the worst time to be doing it, because you will not get any repeat business in the future.
Yeah, absolutely. And I mean, do you think, are we expecting, especially in the tech sector and sort of startup industry sector, are we expecting a lower higher valuations now because of the
I would say, yeah, I mean, I wish I could sort of say differently, but yeah, I mean, that the honest answer is yes, but there is a silver lining, and the silver lining is a low valuation doesn't always mean a bad thing. It means that you can negotiate better on terms. In terms of the exact number, it varies. There is still a lot of money available, because I have to tell you that, so right before we were going into this crisis, and I'm not making this number up, I do this for a job, this is my livelihood, there was $1 trillion worth of dry powder, what we call. So there was $1 trillion in funds, in all funds, sitting, waiting to be invested. So funds have money. Even if that tap turns off, they will still have a lot of money. People always want to make more returns. So at the end of it, if you can negotiate effectively, I mean, Revolut raised, 500 million recently at a good valuation at the end of February, so 5.5 billion. Money is still there. Airbnb raised 2 billion recently. So $1 billion in, equity and $1 billion in debt, literally in the middle. This is Airbnb, whose business has completely dried up. They had an up round. They raised a massive amount of money, 2 billion in this market. So it is there. So valuation on average might be low, but if you're a specific company and you're solving a specific problem, I don't think that should be that big a deal.
That's great to hear for all of us. Brilliant. I think that there's no more questions. We're just getting a lot of thank yous come in the chat. So thank you so much for that session. That was super informative. I learned a lot myself. So I hope everyone else did too. Yeah, absolutely brilliant. I'm more than happy. As I mentioned, just drop me an email if anyone has any questions, wants some more sort of help. More than happy to, schedule some time. Wonderful. Thanks, Ashita. Thank you. Bye. Bye.